decades, banks were thought to be the safest place for your money. But now, something unusual is happening beneath the surface. US bank stocks are sliding at their worst drop in months. Experts warn of growing vulnerabilities, not seen since the last crisis. And despite regulators' reassurances, insiders are whispering, what if the next banking collapse isn't coming from where we expected? In early 2026, major US banks recorded some of their steepest stock declines in years. Leading financial indexes for banks dropped significantly as investors grew nervous about exposure to risky loans and private credit markets. Federal regulators also just finalized stress tests that simulate severe recessions, including sharp unemployment and massive drops in real estate prices. These stress scenarios are not predictions, but they show how quickly a deep downturn could put pressure on bank capital, lending, and reserves. Experts say this is far more than just market volatility. Behind the scenes, banks face several serious pressure points. Private credit exposure. When banks lend to private markets that lack transparency, risk can build off balance sheet without most investors knowing about it. Unrealized losses. Rising interest rates have pushed the value of older bonds and loans down, creating paper losses that can become real if banks must sell assets under stress. This issue has been highlighted by past banking reports and remains a concern among analysts. Stablecoins and technology shift. New digital money like stablecoins could drain hundreds of billions in deposits away from banks by 2028, reducing banks' primary source of funding. This isn't mere theory. Regulatory and industry executives are now actively debating how to contain this threat. These aren't small problems. Together, they create systemic pressure that regulators can't ignore. Some banking leaders, like JP Morgan's CEO, have openly warned that hidden vulnerabilities reminiscent of 2008 risks are resurfacing in private credit markets. And while the Federal Reserve says larger banks remain resilient and well-capitalized for now, history shows that crises rarely come with warnings. Decades of research confirm that bank runs and failures often happen when confidence suddenly collapses, not when fundamentals look perfect. That means even fundamentally sound banks can become unstable if fear spreads fast enough. After the 2008 crisis, banks were forced to hold more capital and undergo regular stress tests. The current regulatory framework, including Basel III standards, is designed to reduce the risk of widespread failure. But critics now say these safeguards may be insufficient for new risks like cryptocurrencies and stablecoins, AI-driven financial decisions, opacity in private lending markets, and cybersecurity and technology risks. Regulators are struggling to keep up with the speed of innovation in finance, and that mismatch could be where danger hides. So what's truly at risk? Not just banks, but your savings, your loans, and the confidence in the entire financial system. If large portions of debt become worthless, if key markets freeze like in past crises, if confidence evaporates, then more than stocks could fall. The whole banking ecosystem could catch fire. And that's a reality most viewers aren't prepared to face. So the real question isn't, will US banks collapse in 2026? The real question is, what hidden risk could trigger the next financial meltdown, and who will see it first? Because when banks stop lending and everyone wants their money back, even the safest institutions can fail.